The biggest property tax shift in years is about one thing: housing supply. Hi everyone, Aidan here. Good to see you. It's Friday the 15th of May. Welcome to my weekly insight where I try to break down the most significant events in the property investment industry over the last week and try to help interpret what it means for us as property investors. So if you've been watching the headlines after Tuesday night's federal budget, you'd be forgiven for thinking that the government just declared war on property investors. But that's not actually what's happened. Once you actually dig into the detail, you see the story that's going on here. In my view, this budget is about simply redirecting where investor money goes. So let's take a look at the headline changes. Firstly, negative gearing has changed, but maybe not in the way that most people think. This is one area that maybe has been misunderstood. A lot of people heard negative gearing changes and immediately assumed, right, property investing's dead. But it's not even close. So here's a simple version of the changes. You can still claim all the normal investment property expenses. So that's interest, depreciation, rates, insurance, repairs, property management fees under the new scheme. That part hasn't changed at all. But what changes from the 1st of July 2027 is this. For established properties purchased after that date, investment losses can no longer be immediately offset against your salary income in each financial year. Instead, those losses accrue and they're carried forward and used later against your future rental income or the capital gains when the property is eventually sold. So the deduction itself isn't disappearing, but it's basically being moved from a claim now to a claim later model. That's a big distinction. There are also several important concessions. One is that existing investors are fully grandfathered, which means your existing properties are unaffected by the changes. Number two, self-managed super funds are fully excluded. And number three, newly built investment property retain the full negative gearing benefits. And that final point is the real story here. The government is very clearly trying to incentivize investors to fund additional housing supply instead of competing for existing homes with home buyers and first home buyers, which in my view is a smart move. What this might do is it may potentially create a two-speed kind of investment market over time. So on one side, you have established properties which become less tax effective for new investors, meaning more negative cash flow month to month and therefore less attractive. On the other side, you'll have new builds, development-linked projects, becoming more attractive because they do retain the immediate negative gearing deduction benefits. Now, that doesn't mean every shiny off-the-plan apartment suddenly becomes a good investment. Far from it. Some new build markets will still underperform badly if supply floods the area. But honestly, that's been true since forever. Too much supply pushes down capital growth, so no changes really there. But what does change is your selection criteria becomes really critical. And honestly, I think this is maybe the biggest takeaway from the budget is that the structure and the asset selection just became even more important. The buy anything and hope for the best strategy was already risky before, now it's potentially even riskier. All right, the next big change, the CGT changes push investors further towards new housing. So, as we know, the budget also introduced major changes to capital gains tax. From July 1 next year, the current 50% capital gains discount for newly acquired assets will be removed. It will be replaced to an inflation indexed system. And there's a minimum 30% CGT rate that will apply. And newly built investment properties would retain the ability to choose between those two methods, the older 50% discount or the new indexation method when they come to sell. Again, the pattern is pretty obvious there. The government wants capital flowing towards creating new housing supply. So not simply recycling ownership of existing housing stock. For investors, this means long-term tax planning may become far more important moving forward. So things like your ownership structure, the asset types, the holding periods, the yield strategies, all potentially become bigger considerations than they were previously. And you need to have those things in place before you purchase. Okay, number 3, the $2 billion infrastructure package might be one of the most important parts. Oddly enough, it was one of the bigger announcements in the budget, but it hasn't had the headlines like CGT and negative gearing changes. But the government committed $2 billion towards housing infrastructure. And this is actually a very, very big deal because one of the biggest reasons housing projects get delayed isn't just planning approvals, it's actually the infrastructure. So you can rezone land all day long from farmland or large lot residential to maybe low density or medium density housing. But if there's no sewage, roads, electricity, transport infrastructure, then nothing gets built, right? Or worse, you get an approval, but then the project doesn't come out of the ground. It sits there in limbo for years while everyone's arguing about who's paying for the roundabout. Is it the developer? Is it the local government? Is it state government? So this funding package is aimed at roads, water and sewage, utilities, essential services, site servicing infrastructure. And this is targeted across metropolitan growth corridors and selected regional markets. Now, in my view, this is one of the more constructive parts of the budget because it addresses an actual bottleneck in housing delivery, not just demand. So government gets a tick from me for that one. Okay, and number 4 is faster planning approvals, which could help developers actually get projects moving. Also in the budget, it includes measures aimed at streamlining planning approvals and reducing administrative delays. Now, I've heard this one many times before, so I'm a little cynical, sorry to say. Holding costs have, as we know, exploded over the last few years thanks to higher interest rates. So if you're a developer, even having like a few months shaved off your approval time can really materially improve whether your project's financial metrics actually stack up, and therefore whether you'll bring that project out of the ground or not. So if they can do it, that may gradually improve housing supply over time. But the important word is there, gradually. This isn't a magic wand or a quick fix. Okay, what this means for our clients. For our clients specifically, the overall strategy remains fairly consistent. We've already been heavily focused on new builds, small development opportunities, value add, supply constrained growth markets. So in many ways, these policy changes actually just reinforce the direction we've already been taking. My final thoughts are this budget feels like a major policy attempt to reshape where investor capital flows. In my view, the result is that the future of property investing is likely to become more strategic, more supply focused, and far more dependent on smart asset selection. Given that these changes are aimed at bringing more supply into the market over time, we may expect to see more moderate capital growth into the future as more supply comes out of the ground. But in my view, that's not necessarily a bad thing because moderating from, say, a really roaring 20% annual growth down to a 10 or 12% annual growth is okay. It makes a market a little more sustainable over the long term. When I'm modeling future capital growth with my clients, we like to assume between 5 and 7% annual growth, just to remain conservative with our assumptions and to be in line with the overall long-term trend for property. So moving forward, we remain focused on thorough due diligence, excellent location and asset selection, and a great client experience as we help our clients grow and scale their property investment portfolio in a safe and sustainable manner. Now, if you'd like a deeper breakdown of which markets and property types may benefit from the changes, feel free to reach out. That's all from me this week. Thanks for listening and have a great week.